Welcome everybody to Wacker Chemie AG. I'd like to talk today about our Q2 results, which we published yesterday. Quite an exciting quarter in a difficult and challenging environment. Let's go through our presentation. So what you see on this picture here up front is actually the beginning of an extension of our facility in Jena, in Eastern Germany, where we're going to build a large mRNA competence center. You may know that we have established with a lot of investments and rather successfully actually pDNA and mRNA competencies, and this is for our BioSolutions business. So here's the safe harbor statement. I suggest to read it, maybe after the presentation. Here's the highlights for our Q2 results. Sales came in at 2.2 billion euros, a whopping 45% over last year, and literally just spread across the entire portfolio. EBITDA came in at 626. First quarter was 644. There was some benefit from Siltronic in the first quarter, so I would call it even, but it's more than twice as high, or nearly twice as high as it was in last year in Q2. EBITDA margin scratching the 30% at close to 29%. Earnings per share over 7 euros, but cash flow down because, well, what do we do in the second quarter? We pay out our dividend. And in this time around, we also paid for the acquisition of a specialty silicones company that fits rather well like a missing jigsaw puzzle piece into our silicones portfolio, the SICO performance materials. But I'll talk about that in a moment. So what happened in our businesses? Across the chemicals businesses, pricing drove results and sales. We increased prices to address unprecedented raws and energy rises. You're familiar with the energy issue. On raws, that was largely silicon metal, but also VAM increased substantially. Polysilicon, on the other hand, stayed tight. Actually, prices seem to be staying up higher for longer than we had originally expected. That's driven by very strong demand in solar and semi. And we have actually lower inventory levels than last year, and we actually also sold less volume than last year's because at that time we were using off inventory. So the SICO specialty silane transaction was closed during the second quarter. Somewhere in our half-year report, you find numbers on the performance of SICO. SICO contributed 8 million euros in EBITDA since the acquisition was closed in early May to the Q2 results. So you'll see this is a business with 30% margins, rather good. On sustainability, well, diversity is here to stay, and that's a good thing. Wacker is internationalizing rapidly, and this means not only with growth in CapEx outside of Germany, but also that management migrates to places outside Germany. So it's no longer all Germano-centric. We have more and more colleagues that run operations from places that are not inside of the area. So also we are recognizing contribution from women. We're making very good progress here. Always difficult in a business that is dominated by sciencey types, but we're getting there. And I think most important in this quarter was that we slightly deviated from a long-standing practice of being extremely conservative on our guidance. And that is that we provided guidance that is rather ambitious, but we'll get there into a moment. Here's something on the background. So you see on the left-hand side the charts and how electricity and natural gas are reaching new highs. War in Ukraine and the hostage situation that Germany experiences with regards to gas supplies out of Russia are not helping. So natural gas drove energy prices up. But we're taking action. So we're not just sitting here on our hands and watching the situation. Since mid-February or so, we have task forces in place that we're looking into where can we substitute, how can we change the way that we do things, how do we source, do we have the right equipment, and so forth. And we've made very good progress on that. So we are looking for alternatives instead of burning natural gas. Can we use alternative fuels, or can we switch to electricity? We've also have a long-standing hedging policy in place. We hedge our raw materials over 36 months rolling forward. And we largely hedged for 22, about 2/3 for 23 and a quarter for 24. I think most important is that we got the message from the grid regulator that our Burghausen combined heat and power plant is system relevant for the regional high voltage electricity grid. And that means It's probably going to be one of the last utilities standing with regards to access to gas, because the electricity provided by that turbine is necessary to keep things up and running in Southeast Germany. So with that, let's look into what do we make of it. Well, we've seen stellar performance across the board in the second quarter, and I'll get to that in a moment. But that means that we need to desperately update our guidance. Our guidance had become a little bit stale. We reached the lower end of our original guidance already with these half-year results. So kind of means that we need to add to our guidance. We now see sales exceeding 8 billion euros, quite a substantial landmark for Wacker, 8 to 8.5 billion euros, so about a billion more than we had originally expected. And we see EBITDA now in a range of 1.8 to 2.3. Now that looks like a really, really wide range, but in reality, the range is between 2 and 2.3 for operational purposes. So why do we take this approach? We say there's a ton of uncertainty out there. And so to address this uncertainty, we split the problem of guiding for results into two parts. The first part is, what do we expect our businesses are capable of doing, even in light of adversity or increasing challenges towards the end of the year? We're convinced that our businesses can supply an EBITDA this year of between 2 and 2.3 billion euros. As a reminder, last year we achieved 1.4, the year before just 600. So pretty good performance. And that despite raw materials increasing 1.5 billion over the last year. So substantial power in here. But we also say we need to address the risks associated with this gas situation, including all potential costs that could ensue from a decision to move away from gas or from gas curtailment. So if we lump all of that together, we get to additional costs of 200 to 250 million. Quite frankly, that only happens if the system relevance of the turbine breaks, which is rather unlikely. But this is the bottom end of the range. So you could say that at the low end of the range, we're 50% of H1, and at the top end of the range, we're 90% of H1. But I would say I would look at the 2 to 2.3 billion for the true underlying earnings power. Now, what have we done in Q2 so far that has helped us move forward? You remember we talked about a strategy that we deployed and announced at the Capital Markets Day at the end of March, with some really ambitious targets with regards to the growth of the business and our market positions and so forth. Files are all available on the web. Have a look at it. I like it. So we've opened up a silicones production site in India that is rather promising. We have substantial space there so that we can grow this site to a substantial size over the next couple of years. Panagarh is not far from Calcutta, so that gives you a geographic idea, and we already have a very well-functioning joint venture in that area. We're also expanding capacities, upstream capacities in Burghausen and Nünchritz, and so that's our German plants, literally because we run out of material. So we need more. Demand for our products is so strong, we just need more. The BioSolutions, we just talked about this at the front page, opened up an mRNA competence center in Eastern Germany. And at the same time, we're opening a biotechnology research center in Munich. Quite interesting, cooperating with the university here in Munich, Technical University of Munich, a world-renowned outfit. So this is going to propel innovation and research for our biotechnology business. We've also opened a regional innovation center and admin center in Ann Arbor in the US. So that's for biotech and silicones, and Polymers is making progress on their plant expansion in China despite all those lockdowns, which is actually quite a success story. Now let's move to the P&L first. Obviously, you see everything driven by price, a little bit by volume mix, tiny tailwind from FX. What you see here in the gross margin is essentially the effect of the price increases. What you see across the board, vastly improved numbers. The results, this spot here includes 21 million contribution from Siltronic, by the way. So this gets us to a ROCE in the second quarter of well over 20%, close to 30%. Let's have a look at the balance sheet. I told you before that there's a rather sensitive response to changes in the discount rate. With every 50 basis points that the discount rate increases or decreases, our pension liabilities move by 400 million euros. So what you see here is that our pension liability decreased by over €1 billion since the end of last year. So in the first 6 months, just €1 billion in lower pension liabilities. And if you compare that to the prior year, end of 2020, it's actually over 2 billion. So pensions peaked at 2.7 billion and they're now down to 600. For those of you who consider pensions debt, we can have a discussion about that, but I know some people do that. It's probably worthwhile putting that new number in your valuation sheets. But we also saw working capital increases. Well, that comes if your sales fly up and if raw materials increases, this is it. Substantial amount of cash and securities on the books and actually ending the whole year, the whole quarter again with a positive net cash position overall. So let's have a look at the pension evolution here, see what happened from close to 0 up to 3.3 and how that contracted. I think with the latest news of further rate hikes, that we can expect that number kind of to vanish over the next probably year or so. So there we end up with silicones, our largest business, highly innovative business, spread across regions, industries, customers, generations of products, and so forth. Rather resilient. About 15% of sales are commodities. These have come lately a bit under pressure. Supply, additional supply, typically servicing the more volatile, more cyclical parts of the industry, such as construction or textiles, and hence highly receptive to mood changes or PMI changes. What were the highlights in Q2? Sales were driven by the strong pricing that we experienced in specialties, but also the 8 million contribution from SICO. Pricing is really the main driver for EBITDA. You see the substantial change between Q2 this year and Q2 prior year. EBITDA increased by over 100%. That's largely due to pricing. Now, our outlook for this year is rather steep. We can get there. I'm actually quite convinced that we can get there, but it's a high number. Never seen a number this high in this business. 3.5 billion euros of sales with an EBITDA between 900 million and 1 billion euros. Now let that sink. That's 1 billion euros from silicones. Wow. Pricing is stable in specialties, volumes also. Some slowdown, as I said, in the more cyclical parts of the business, but in the quarter-on-quarter comparison, profitability will be somewhat under pressure because we no longer have trailing benefits from raw materials that we enjoyed, especially in the first quarter. Let's move on to our second largest chemicals business. This is the Polymers Division. Polymers came in with a result pretty much on the level of the prior quarter. Now, what's the big difference? Sales increase and margin kind of contracted. It's really the rise in raw materials and time delays and passing that on. We continue to face very strong demand across the board. We have pricing increases in place and our surcharge system in place to address the rise in raw materials and ancillary costs. Effectively, this means that we've come to a much closer match between pricing and the change in raw materials. In the past, it always used to be adjusted on an annual basis, and that is now adjusting much more rapidly. To our welcome surprise, because we had expected difficulties with our customers with this approach, but apparently that seems to be working. Also, the approach that we've chosen is highly collaborative. I think we faced in the course of the last year, this business alone, since Q1 2021, is in raw material cost increases of over $600 million euros, and we've passed on 600 million of that. So our customers appreciate that we share the burden with them, and that has actually meant that despite us increasing prices 10 times in a row, we've actually increased our market share. Quite a feat. So we see sales reaching this year 2.1 billion euros and an EBITDA on par with a prior year. Now, if we look into the third quarter, there's going to be a turnaround which will drop the results in the third quarter by about 30 million or so. So we see here some signs of weakening in demand. I mean, you've heard this from all the various coatings companies who are our customers, that there's especially signs in Europe and in China. And there's also some destocking as there are expectations about decreasing raw material prices, well, which you can see at the back end of the presentation and the appendix is not materializing. So expect us to continue to compensate further cost increases with higher prices. Let's move on to BioSolutions. So sales growth here, actually largely driven by bioingredients this time. We had suffered from a force majeure in our life sciences business that occurred earlier this year, and we were able to conclude that early May, well ahead of plan, and that meant that these units were running again. We saw groundbreaking for an RMRA production site, as we talked about. Our sales outlook is somewhat unchanged, but EBITDA will be lower. And the three reasons for that are A, the force majeure, B, the investments in digitization for our biopharma business, ability to trade and deal with customers with SAP and other ERP systems, but also because a large customer is not servicing their contractual obligations. So we think that earnings from that contract will have to be deferred into next year. We're in arbitration, so let's see where this goes. Polysilicon continues to truck along nicely. You see a slight decline quarter over quarter to only 37% margin. Geez, what standards? So prices were sequentially higher in Q2. We saw very strong demand for solar and semi polysilicon. So not just the solar that everybody talks about, but also semi is trucking along. We keep getting share and sell more and more material. We now think that we can achieve sales of 2.1 billion euros in polysilicon with an EBITDA between 700 and 850 million euros. And so that means that if you look into the first part of the year, which is about 440 million, in the second half of the year, that profitability in H2 will be lower. And the core reason for that is that we're facing significantly higher raws and energy prices in the second half versus the first half. So where's our financial position? You see the cash flow generation here. The cash flow for long-term investing includes M&A of 185 million euros for SICO. You see the 400 million paid out for dividends, and net financial assets were 120 million after all those things. Here's our updated guidance for the full year. So over 8 billion euros in sales. EBITDA at midpoint, I would say 2.1, but including all those provisionary or prudent charges that we put in there for potential gas costs, it's from 1.8 to 2.3 billion. EBITDA margin roughly comes out at the same level as last year. We see cash flow clearly positive, CapEx around 600 million. Please note that M&A is not included in the CapEx, and positive net financial assets. But also net income, which is the basis for a dividend payment, is going to be substantially higher than last year. So depreciation stays at 400. ROCE also significantly higher. The cost of capital we estimated at 10%. So probably in that vicinity, maybe a bit up, and tax as well. There you go. So that's what we can say about the second quarter. It's been a pretty strong quarter. There are some emerging clouds on the horizon. Yet you see, despite those, we are not seeing any significant slowdown in earnings or in sales development. I think that speaks to the strength and the resilience of our business model. This is an exciting place. If you have additional questions on Wacker Chemie, please feel free to call. You'll find our contact details on the last slide here, and I'm looking forward to speaking to you. Thank you.